Nobody planned to lose money. That is the part that makes this story so uncomfortable. On January 26, 2026, silver was sitting at $121.64 per ounce, all-time high. Never been there before in the entire recorded history of the metal. People were euphoric. Forums were exploding. The word moon was appearing in financial commentary written by people with credentials on their walls. 4 days later, 30% was gone. In a single session. And here is the question that has been bothering serious investors ever since. Did that happen by accident? Because when you look at the sequence of events, the timing, the players involved, the decisions made, and who ended up holding the losses, it stops looking like a random market correction very quickly. Was the silver crash of 2026 a natural market event? Or was it something else entirely? By the time this is over, you will have everything you need to answer that question yourself. And the answer matters, because silver is still trading at $67 today, and what you believe about why it crashed will determine every decision you make about it going forward. Welcome to OG John Hub, where we break down what is really happening with your money. Let us go back to the beginning of 2025, because the crash did not start in January 2026. It started much earlier, quietly, in the supply and demand fundamentals of a metal that most people had ignored for decades. Silver entered 2025 trading at approximately $30 per ounce. Unremarkable, stable, the kind of price that produces no headlines and attracts no crowds. But beneath the surface, something structural was shifting. The Silver Institute, the most authoritative body tracking global silver supply and demand, had been documenting a supply deficit for 4 consecutive years leading into 2025. The world was consuming more silver than it was mining, every year, consistently. And the gap was widening, not narrowing, because industrial demand was accelerating faster than new mining capacity could respond. Solar panels alone consume an extraordinary amount of silver. Each panel requires a small but non-negotiable quantity of silver paste in its electrical contacts, and the world was installing solar at a pace that had no historical precedent. Electric vehicles added another layer of demand. Semiconductors, medical devices, AI server infrastructure, which requires silver in its cooling and conductive components at scale. These were not speculative demands. They were purchase orders, contracts, production schedules. Then on January 1st, 2026, China made an announcement that changed the mathematics of the entire silver market overnight. Beijing reclassified silver as a strategic dual-use material. In plain language, that meant China, the single largest industrial consumer of silver on the planet, was signaling it intended to accumulate silver reserves for national security purposes. Think of it like this. Imagine the world's largest buyer of wheat suddenly announcing it was going to stockpile grain indefinitely. What happens to wheat prices? They do not drift upward politely. They explode. Silver went from $30 in early 2025 to $121.64 by January 26, 2026. That is a gain of more than 300% in 12 months. The largest annual gain the metal had recorded since 1979. And then someone made a decision. On January 30th, 2026, the CME Group, the Chicago Mercantile Exchange, the world's largest and most powerful futures exchange, announced it was raising margin requirements on silver futures contracts to 15%, effective immediately. Now pay close attention to what that actually means, because this is where the story gets complicated. When you trade silver futures, you are not buying physical silver. You are entering a contract to buy or sell silver at a future date. And the exchange lets you control an enormous position with a relatively small deposit, called margin. Before January 30th, a trader controlling $100,000 worth of silver futures might have needed to post only $5,000 as collateral. The exchange was effectively lending the rest. At 15% margin, that same position suddenly required $15,000 in collateral. Immediately. Not next month. Not after the market closed. Right now. If you did not have that additional $10,000 sitting in your account at that moment, your position was automatically liquidated, sold at whatever price the market offered. You did not get to make a choice. The system made it for you. Sit with that for a second. Thousands of traders simultaneously across the globe having their silver positions forcibly sold, not because they had changed their view on silver, not because the fundamentals had shifted, but because an exchange in Chicago had changed a number. The resulting wave of forced selling hit a market that was already extended beyond its short-term fundamentals. Silver did not decline. It collapsed, roughly 30% in a single trading session. That is not a typo. 30%, one day. If this is the kind of honest, clear breakdown you have been looking for, hit that like button right now and subscribe to OG John Hub. Every week we bring you exactly this, and share this video with one person in your life who needs to hear it. But here is where the story stops being a straightforward market event and starts raising questions that the financial media has been remarkably reluctant to ask. The CME Group is not a neutral party in silver markets. It operates the exchange where silver futures are traded. It collects fees on every transaction. It sets the rules that govern how traders can participate. And it has the power, unchecked, unilateral power, to change margin requirements at any time for any reason with minimal notice. This is not the first time a margin hike has been used to crush a surging commodity market. In May 2011, silver was surging toward $50 per ounce. The CME raised margin requirements 5 times in 8 trading days. Silver collapsed 40% in 2 weeks. The timing then was as striking as the timing now. Who benefits when silver crashes? Large financial institutions that had accumulated short positions, bets that silver would fall, profit directly when prices collapse. The bigger and faster the crash, the larger their gains. According to data from the Commodity Futures Trading Commission, which tracks the positions of large commercial traders, the weeks leading up to January 30th showed an unusually concentrated buildup of short positions among the category of traders classified as commercials, a category that includes major banks and financial institutions. Actually, let me put that differently. In the weeks before the crash, the entities most positioned to profit from a silver collapse were the same entities whose trading activity the CME is designed to serve. And then the CME changed a rule that guaranteed that collapse would happen. Is that a conspiracy, or is it just how the game works? That is not a rhetorical question. It is the most important question any silver investor can ask. Because if margin hikes are tools that can be deployed selectively to suppress commodity prices that threaten certain financial interests, then understanding that dynamic is not paranoia. It is essential due diligence. The algorithmic layer made everything worse. Modern markets are dominated by algorithmic trading systems that respond automatically to price movements. When silver broke through key technical support levels on January 30th, levels that thousands of algorithms were programmed to monitor, the systems generated enormous waves of additional sell orders within milliseconds, not because a human being had made a judgment, because a line on a chart had been crossed. 5 forces hit simultaneously, the margin hike triggering forced liquidations, the algorithmic cascade amplifying the selling, the strengthening US dollar making silver more expensive for international buyers and reducing their demand, the Federal Reserve signaling a pause in rate cuts, pulling capital toward dollar assets, and ETF outflows as retail investors watching silver funds like the iShares Silver Trust, ticker SLV, panic sold their positions, adding yet another layer of selling pressure to a market already drowning. The result was not just a bad day. It was a demonstration of exactly how fragile speculative leverage is when the rules of the game change without warning. And this is where the real education lives, not in the drama of the crash itself, but in what it reveals about the nature of these markets and how to operate within them without getting destroyed. The first thing the silver crash of 2026 teaches is that the rules of any market are not fixed. They are set by institutions that have their own interests, their own relationships, and their own incentives. The CME can change margin requirements overnight. Exchanges can halt trading. Regulators can intervene. Any investor who builds a strategy without accounting for the possibility of rule changes is building on sand. Not because rule changes are inevitable, but because they are possible, and possible is enough. The second thing is about leverage, borrowed money amplifying your market exposure. Leverage is not inherently wrong. It is a tool, but it is a tool that cuts both ways with a violence that most people do not viscerally understand until they experience it firsthand. The traders who were wiped out on January 30th were not stupid. Many of them had correct views about silver's long-term trajectory. They were destroyed not because they were wrong about the metal, but because they were using borrowed money in a market where the rules could change mid-session. Being right about an asset and surviving an investment in that asset are two entirely different things. The third thing is what I think about every time I see breathless price predictions in financial media. When silver was at $121, the headlines were projecting 150, then 200. The louder and more unanimous the bullish consensus becomes, the more dangerous the crowded trade. Not because the consensus is always wrong, but because crowded trades collapse with particular violence when the reversal comes. Every investor who bought near the peak because they saw the headlines and felt they were missing something paid a catastrophic price for following the crowd at exactly the wrong moment. The fourth thing concerns the distance between price and value. Silver at $67 today is still 87% higher than it was 1 year ago. The investors who bought early and understood what they owned are sitting on extraordinary gains despite the crash. The investors who bought at the peak are sitting on devastating losses. The metal did not change between January 26th and January 30th. The fundamentals did not change. The supply deficit did not change. What changed was the price, violently, suddenly, because of leverage positioning and a margin rule adjustment. Price and value are not the same thing. They can diverge dramatically in the short term. Understanding that distinction is not a refinement of investing skill. It is the foundation of it. So where does that leave you today, sitting here in June 2026 with silver trading at approximately $67 per ounce? Goldman Sachs, according to their most recent published research, expects silver to average between $85 and $100 per ounce through the remainder of 2026. Citigroup has published a target of $110 per ounce for the second half of the year. The Reuters consensus forecast across major analyst institutions places the average 2026 silver price at approximately $79.50. The structural supply deficit that drove the initial rally has not resolved. Industrial demand from solar, electric vehicles, and AI infrastructure has not softened. China's strategic interest in the metal has not reversed. The case for silver is not dead, but it has been clarified by what happened in January in a way that every serious investor should receive as a gift rather than a wound. The silver crash of 2026 was not purely an accident. It was the predictable consequence of speculative leverage meeting a rule change in a market where the rule maker has its own interests. Whether you call that manipulation or mechanics depends on your threshold for those words. What you cannot call it is surprising, not if you understood how futures markets actually work going into it. The investors who will do well with silver from here are not the ones who guess the price correctly. They are the ones who own it in a form that cannot be margin called, physical silver, or regulated ETFs held without leverage, and who understand that the road to any meaningful price recovery will likely include more volatility, more surprises, and more moments where the rules change without warning. Leave your answer in the comments right now. Do you believe the CME margin hike on January 30th was a neutral market mechanism? Or do you think the timing was something more deliberate? I want to read what you think. There is no safe answer here, and that is exactly why it is worth asking. And remember, everything discussed here is for education and discussion only. This is not personal financial advice. Your money, your decisions, your responsibility. See you in the next one.